Investec coming out with its annual results today and annual earnings down some 26%. You'll remember that the group did put out a trading update in March saying that earnings would be down around about 27%. So no surprise on that side. In studio in Johannesburg, I've got the CEO of Investec, Stephen Koseff. Stephen, obviously your verbiage alluding to the fact that you had increased bad loans in Australia and a weaker investment banking unit. Are we seeing remedial action being taken in these operations?
Well, I think we've dealt with the issue in Australia, and part of the write-offs were a consequence of cleaning out a book. We reorientated the whole Australian business over the last year to 18 months, and we believe it's now, a reasonably well-shaped platform that can help us grow and build a business there. So I think Australia's dealt with. In the investment banking side, Kimon was talking about some kind of a disaster coming down the road at us. And investment banks depend on flow. And that has been a little bit more difficult, although we did quite well in corporate finance around the world. And we've struggled in the institutional broking business, as most institutional brokers would have struggled, as asset managers don't really want to pay us for our services. And then we had our investment activities generated lower earnings in this particular period than in the previous year. And last year we did a debt buyback in the previous year that was not repeated, where we made a gain on our buying back our own debt, which is not real earnings. Obviously it was a profit, but it's not real earnings. So yeah, it has been a very tough environment for us. Sorry, Brownwyn.
Before I throw it to Kimon, I just want to focus on the cost element and whether you are now aggressively going to take costs out of your investment banking business, or is it too early to make such an aggressive move, Stephen?
Now, we took costs out last year in this particular last period. Remember, we bought Evolution, and a whole lot of people came across from Evolution. So we've already taken costs out of that system, and we took costs out of our broking business as well. So I don't think there's a lot on the cost front from our point of view. Obviously, we now have to generate the revenue or ride it out if the markets are going to be as bad as Kimon says they're going to be.
Kimon, you want to pick it up here?
I think if you take a look at Investec, it's a lot different to the rest of the banks that you may find in South Africa. I think they're in the right sector of the market. Investec has traditionally been for high net worth individuals, a banker. And I think one of the things that I do like, if you see some of the big four here locally, the commercial banks, I think they've got a lot of unsecured loans. I like the way Investec handles risk. I think they've got a very astute risk management team. And I think they take write-downs sooner than others. You've heard me criticize banks before for having assets on their book at book value. And I suggest in terms of property loans, if you scratch the surface, you probably find that the local banks have not written down what they should have written down. So I think, I think there's a bit more aggressiveness in the way Investec would approach it. And hence, I would favor them because I think the quality of their book is superior to the rest of the banks.
But Stephen, we know that this is pretty much a sentiment game, and now we've got a risk off play across the board that is going to hit banks with any international exposure in the South African space as Investec. Where do you think we're going with this? We've referred to Armageddon, we've referred to a catastrophe. Do you think we're going back to 2008, 2009, or are we going to be better off this time around?
Yeah, look, as I said to you last time, I'm a lot more optimistic than Kimon. I think that, you had a massive bubble in the system in 2008. That bubble has burst, and asset values are significantly lower priced. I hear what Kimon says about property in Spain. I don't really agree with him in the UK. UK is a liquid market, and there's a lot of buying that has been coming in from all over the show, and it's held up quite well. It initially came down 20%, and now it's since recovered some of that. So I do think that the Europeans will work it out, and that there will be an orderly exit. I think that for Greece is going to face some kind of Armageddon, as Kimon points out, and that could flow into the other euro areas. But Europe suits the big guns like Germany. They're an economy that is growing and doing well, and they're doing well partially at the expense of their southern European neighbours. So I do think they recognise that, and I think that there will be some help forthcoming. But clearly, it looks like Greece can't stay in the euro. The question is whether it's going to be an orderly or disorderly exit. And, you know, there are ways for it to exit in an orderly way that doesn't cause a disaster. If it's disorderly, well then, you know, it could be a Lehman's moment and we don't know where life leads. But I do think that the world is a lot less leveraged than it was in 2008. Banks have increased their capital significantly. Yes, there are some areas where they have to increase it a bit more, but they've gone from, you know, being leveraged 60 times to being leveraged 20 times. So I do think a lot of the puff is out the system, and now it's just a question of the hard grind. But we are in a tough world, and we're going to see this for, you know, a number of years still to come.
Let's move away from the international assets within the fold and focus on your South African operation. What are you seeing on the ground in South Africa?
We have seen reasonable activity on the ground. We've seen our default levels come down quite significantly from about 5% of our book to 3.7%, and our net defaults down to 2.6%. They're not where they were in 2007 yet, but they certainly have been shifting in that direction. Our private banking business has started to recover, and it was nicely profitable this year, but certainly still got some way to get to its earnings of a few years back, and we believe that, you know, if life continues in the way it is, that will be on the cards in the not too distant future. Our capital markets business did very well this year. Our advisory businesses did well. Our asset management business held its own. Our wealth business grew in this past year. Our property business, you saw they launched their property fund at the beginning of April last year, and that fund did particularly well. But we made a gain on selling a whole lot of properties into that fund last year, which was not repeated, but they still did well. So, and we didn't do as well in our investment portfolio as we did last year. So you saw our earnings from principal transactions and investments were down quite a lot. But overall, our earnings were flat in South Africa. And, you know, not up like some of the retail banks, but certainly as, you know, as good as, if not better than their equivalent businesses to ours.
Where do you want to see your cost to income ratio?
Well, you know, it's within our range, and as South Africa was 56%, so it's 1% above where, you know, we target it to be. Globally, it's below 65, and it will live between 60 and 65, and so we're comfortable with that sort of number. Because we have big asset management business, asset management cost income ratio 64. Our wealth businesses, if they're operating very effectively, will be at around 68 to 70%. Our banking businesses are at 60, and we need them at 55.
And in terms of a targeted return on equity for the group, perhaps we can close there, Stephen.
Yeah, I think obviously return on equity is low at the moment. South Africa was 14.9, but with the issues in Australia, you know, it was only a couple of percent in our developed world businesses. Our aim is to get our overall return on equity up to a range of between 12 and 16. We want the UK and Australia above 10, and we want South Africa above between 15 and 20, living in an overall space of between 12 and 16, depending on the season. So when interest rates are zero in the whole world, it's very difficult to get those returns of equity of 20 that we saw in the heyday, and I don't think we'll see those for a long time in the banking world. But, you know, we believe
Stephen, thanks so much for your...
We can get to our target range within the next while. Thank you.
Stephen, thank you very much for your time. That's the CEO of Investec, Stephen Koseff, speaking about his annual results and coming to us live from our studio in Johannesburg.